Fantastic. Welcome, everyone. My name is Jim Brady. I'm the Senior Director of Sales at Henry Schein Financial Services. It's fitting that I'm broadcasting live tonight from Dent Supply Serona World, the large trade show in Las Vegas, a wonderful industry event. And on behalf of the entire team here, thank you for joining our annual year-end tax planning webinar as part of the Henry Schein Dental Business Institute webinar series. Tonight, I am joined by Bob Gray. Bob is the owner and partner at Gray Pilgrim and Associates, and actually a founding member of the Academy of Dental CPAs, the ADCPA. Bob's been featured as part of the Henry Schein webinar series for several years now. We were just reminiscing about that, and continues to bring over 30 years of experience, not only to Henry Schein, but to all of his clients. So Bob's going to be spending some time tonight discussing 2024 tax planning topics, including maximizing your deductions and, importantly, Section 179, as you strategize on those equipment purchases for year end, which it quickly approaches and always comes up much faster than we all ever imagine. A few quick housekeeping items. If you have any questions, please type them in the Q&A box, and we will answer them live at the end of the presentation. A friendly reminder that CE is not available for tonight's webinar. And we do have, I think Shirley will be putting in an exclusive tax tip worksheet for everyone tonight, which we'll be putting in the chat here shortly if it's not there already. So thank you again for attending. Thank you, Bob, for your participation and continued support. Without further ado, please welcome Bob Gray.
All right. Thank you very much, Jim. Welcome, everybody, tonight. Welcome to those, again, who, if you've seen me in the past, I've been a supporter of Henry Schein, and as they have been of Gray Pilgrim, and I'm happy to be here. For any of you first-timers, welcome aboard. We need to start with, of course, what the attorneys always make us do, that Henry Schein is not really in the business of providing tax advice here. And in all kidding aside, this really, the point of a webinar like this is to light the fuse and hand it back to you so that you go back to your tax preparer and your advisors and can now talk more intelligently and get better advice. And so that really is the point here today. I am Bob Gray. I am very proud to be one of the founding members of the Academy of Dental CPAs, but I'm also an instructor for the ADCPA Business of Dentistry courses that have been held in the Caribbean, out in Hawaii, in their week-long sessions. They came to an abrupt halt during the pandemic, but they're going to be starting up again in 2025. So we're probably either going to Aruba or the island of St. Martin. It's Monday through Friday, start at 8 a.m. and by noon, you're on the beach. So you get the full ability to tax deduct because it's a 4-hour day, magically. But anybody interested in one of those, stay tuned to the ADCPA. We'll find that coming. I'm obviously an instructor for tonight's Henry Schein Academy and their virtual programs, but I've also lectured to dental societies really all over the U.S. So if you're looking for a speaker, give me a call. I'm available. When I'm not doing accounting and doing debits and credits, my wife and I love going out to Napa and chasing down those little boutique vineyards, the little ones that have those 100-point wines that are tucked away. And, they're not Sutter Home or any of the really big things out there. They're along the path. But for anyone of you who are real true winos tonight that want a recommendation, try Tres Perlas. It's some incredible wines. I'm sure you can find them if you Google that. We talked about the ADCPA, but I wanted to just give you a little bit of a background. I mean, the ADCPA as a group of accountants, and in order to get in the ADCPA, you have to have at least 75 dentists as clients. But we don't really want to just have, accountants who happen to have dentists as clients and really don't know much about dentistry. So we really, really look for all the members to be engaged in the dental community. You have to either write for dental economics, do webinars like this for Henry Schein, teach at some of the dental schools and programs. You've got to be engaged in really trying to help dentists be better CFOs. And if that proves that you really understand what dentists do and how you could truly help them. The ADCPA is pretty much all over the U.S. If you go to adcpa.org and click on the map, you'll see all the stars. You can just type in, find an accountant near me, and you will come up with the one that's in your area. And for any of those places, if any of you that are in states without a star on it, almost all the states are covered. For anybody that's not For instance, the Utah and the Colorado people, cover Wyoming as well. So if you're anywhere in the U.S., there's an ADCPA member for you. People ask me all the time, though, I said, Bob, aren't all the tax rules just the same? What's the difference between dentists? But the big difference is, quite honestly, that if you don't really know how your practice functions, if you're talking to an accountant that really doesn't understand, it's really to help, very difficult for them to help you improve your net income, because it's not just about saving taxes. The real idea is, how could someone help your practice improve? How could someone really help you achieve a higher goal? And I always say that if your current accountant can't point to tooth number 8, you should find one who can. Shockingly, I'm one of those. Shameless little plug of anybody interested in talking to an accountant who does know. Certainly give me a call. My contact information will be up at the end here. I'll put that up on the board. Here's what we're really going to talk about, though, tonight. I want to talk first about these ERC refunds. We're going to go into a little more detail about that, because the IRS really, really is angry about the number of ERC claims that were filed incorrectly. And, they say fraudulently. I'll say maybe just erroneously. We're also going to talk about the QBI deduction. The QBI deduction is something I still been around since 2018, and I still talk to people that go, oh, what's QBI? So we're going to talk about that to make sure you know how to maximize that. And the pass-through entity tax has been around for the last few years, and depending on which state you're in. And that's where the actual dental practice entity itself, your partnership, your S-corp, whatever it is, actually pays your state tax for you and takes a deduction for it. I'll show you an example we have coming up here in the program later on. And also, we're going to talk about Section 179 and bonus depreciation, and how purchasing equipment kind of affects that. I'll remind you again as we go in the program, but I always say taxes are on sale when they're only like 12%, right? I've had people come to me and brag and say, hey, Bob, I built a new building and I didn't pay any taxes, last year because I bought all this equipment. Well, I think that was a mistake, because what happened was, remember that you used some of those tax deductions in the 12% tax bracket. Boy, I think you ought to save those for the 30 and 35% brackets. It's a lot more effective to do it that way. Again, we'll go into an example about that. Then I want to talk about retirement plans, because there's so many options out there, and understanding how many choices there are and which one's right for you, I think is something we're going to be touching on tonight. Well, there's several other things I have included in here, but one of the things I want to make sure we leave time at the end for questions. One of the things that's the most beneficial, I think, if you log into something like this, you've got access to a free account for tonight. So if you put questions in the Q&A, we'll try to answer as many of them as you can. If you think about something afterwards, I encourage you to take down my email address. We'll come up here at the end. If you ask me a question that's going to take me 5 hours to research, or I'm going to cry foul, but I've many times answered many questions post webinar here. So again, feel free to reach out if you think we can help. Let's get started with just some of the basic stuff here tonight. The standard mileage rate has been jacked up tremendously over the years. We're up to 67 cents per mile, up from 65.5. And that's kind of significant, because if you're driving an older car, many times you can't beat that rate when you multiply the mileage. So that eliminates you having to keep all your gas receipts and all that sort of thing. You just have to keep some mileage records, and you can qualify for the standard mileage rate on a vehicle that hasn't been depreciated before. One of the other big changes for 2024 is that the residential clean energy credit is 30%, but it also applies now to battery storage technology. So if you're talking about the Tesla wall or things like that, the government's paying 30% of the cost for you to either install or utilize some of these things. I mean, that's a pretty big deal. Everybody will take free government money whenever they can get it. There's also been a pretty big change in the itemized deductions and the standard deduction. I want to talk about tonight about how to maximize those itemized deductions, though, because what's happened, if you look at the top of the screen, the joint standard deduction is $29,200. That means if I don't have anything I can prove, zero, I don't have any contributions, I have nothing, I still get $29,200. Now, if I can prove that I have more than that and I can beat that, I can take a bigger deduction. But since currently taxes are limited to 10,000, that only leaves 19,200 for charitable contributions and mortgage interest, a few other small things. A lot of people can't beat that. So the itemized deductions is really pretty good. But for all those of you that hover near that deduction limit, I want to show you an example here if you follow, where it says even gifting. Let's say that you're in the habit of giving your favorite charity $4,000 a year. If you look at this, because I've got 10,000 for taxes, 15,000 mortgage interest, I only have 29,000 of reportable, standard itemized deduction. So I get the standard deduction because it's higher. However, what if I told my charity, tell you what, this year I'm going to give you the 4,000 in December and next year's 4,000 all in December of this year. Total same amount of cash flow commitment, et cetera, same benefit to the charity, but look what happens, because of the 2 years combined, I saved an extra $1,520 for making that charitable contribution. The answer was before that, I didn't get any benefit at all because I still got $29,200 regardless. So if you can kind of maximize that and load up on those, those deductions, it can be a big help in maximizing that. Let's jump off on the ERC because I want to talk a little bit about what it is. I don't know how many of you that are on here tonight actually got an ERC refund, the employer retention credit. Here's how you were supposed to get it. Okay. The language says I should have sustained a full or partial suspension of operations due to orders from an appropriate governmental authority. Now, that partial suspension can't be because you said, I need more distance between patients. I need more time to clean up an operatory in between. It had to be a government authority that told you not to do that. But the other clear line was a significant cut in receipts. If you lost 50%, if you had a 50% reduction in receipts, when you compare 2019 to Q2 to quarter 2 of 2020, you automatically qualified. And also, if you're a recovery business, if you were not in business in 2019, but you first opened a practice in 2020, you could be eligible for that as well. And a recovery business is one that just basically started after February 15th of 2020, so they didn't have any prior revenue to compare it to. And with the start of practice, your receipts were not likely to exceed $1 million anyway. And of course, you had to have payroll in order to qualify. But here's the thing, this is an example of a government mandate. If you look at the red arrows under Arizona off the lower left corner, there was a stay-at-home order issued on March 31st, and it was lifted on May 15th. So you were not permitted in Arizona to operate a dental practice legally during that time period. That time period, and that time period alone, is what really qualifies, in my opinion, for the ERC credit. Now, there's a lot of people out there, a lot of these refund mills and these refund specialists, as they've called themselves, who've come back and said, oh, no, it just takes, for you to be affected by the COVID pandemic. Well, that would have been everybody. The government would have had to just, hand out money to everyone. But this is an example of what the government thinks was a mandate. So if you don't, hit the drop in revenue rules, you might want to reconsider this. The ERC was, for 2020 was 50% of qualified wages. So it was $5,000. In 2021, it was 70% of qualified wages, up to $7,000 a quarter. So the maximum was $21,000. There was a lot of these, I want to call them refund mills or, refund specialists that were running around saying, hey, get $21,000 for every employee that you had. And they actually filled out the claim forms, and regardless of whether the person really qualified or not, just sent it in. And the problem was that, Congress charged the IRS with quickly paying these things out because everybody was in distress. And so they needed the money. So Congress said, don't spend a lot of time. Just when the claim hit, just send them a check. Let's get it going. So there was no scrutiny about that. And I think that really that was what brought on, I think, a lot of fraud or a lot of just erroneous claims. Again, but these things, these guys charged as much as 35% of the refund for getting it. And I would just tell you that, again, beware. Here's the reason. The employer, this is one of the right off the IRS website. Employers warned to beware of third-party, improper, ERC claims. And they're talking about, penalties and interest if you had to pay that money back under audit. And the penalties are very steep. And, all I can tell you is you do not want an audit if that's, if there's any question about that at all. The IRS does have a voluntary, disclosure program, which basically was an amnesty program that said, turn myself in. Well, the first one ended, and the second one is now open through November, where you basically can come back and say, listen, I'm just not confident about the calculation. I'm not confident about the quality of the advisor that I use, whatever. I don't want to get in trouble. You can keep 15% of the money, send the rest back, and get amnesty and not have to deal with an issue. Here's the problem. Let's take an example. Let's say somebody got a $100,000 ERC refund, and the provider took, let's say, 30% of the money, the refund mill. Now the doctor has $70,000. That's great. If the IRS comes back, however, and finds that that was an erroneous claim, they're going to say, hey, we want $150,000 back. Remember, the doctor only got $70,000. But the doctor's now got to pay $150,000 back and try to go back and get the $30,000 back that they paid the company. A lot of those refund mills won't be in business. By the time you go to call a number or knock on a door, they're gone, right? Because the program's been over for a while. So I think those doctors who got 70 and pay back 150 will be really disappointed in the decision to follow through with that. So I don't want to really overdo this, but just make sure that you're confident that if you got an ERC refund, you were one of those practices that qualified for it. I want to flip, and talk about the QBI, because as I mentioned before, that's something that really gets, overlooked. And I'm surprised how often it is overlooked. When we do returns, we do reviews of other, people's tax returns. It's 20% of your business income, but business income does not include a W-2. So it's all of the K-1 pass-through income or your Schedule C income for a sole proprietor that can be 20%. 20%, that means you only pay tax on 80% of the money that you made. That can be really good. The problem is that in order to qualify for this QBI, they put, dentists in a special group of people that had a lot of restrictions, and they're all income based. If you're a dentist, you have a restriction. If you're a real estate investor, or, production company, you don't. So it's just, I'm not sure how Congress thought to pick on accountants and attorneys and physicians and dentists, but they did. But it really does apply, and I think I'm going to show you an example coming up here of how lucrative all of that can be when you're talking about, saving 20% on the taxes. I'm going to switch to talking about dental equipment. Then we're going to pull these two back together in an example here in a minute. For bonus depreciation, Section 179, which is the ability to immediately deduct whatever you bought, regardless of the fact that it has a useful life of more than 1 year, is up to $1,220,000 for 2024. That you cannot spend more than $3 million in order to qualify, because that means you're a big business, and they don't want large businesses to have the Section 179 limit. But for most of you, I think purchasing $3 million of equipment is probably an okay limit you can live with. Bonus depreciation is different than Section 179. It's a different section of the code that was created to let you immediately tax deduct what you bought. It used to be 100%. It dropped down to 80%, last year. Now it's 60% this year. It's fading away. But we will be left with Section 179 unless, Congress gets in and meddles with that as well. This works for new or used equipment as well, but it must be in place by the end of the year. I constantly hear people say, hey, on December 31st, I made a decision to buy some equipment. I called my equipment rep, and they, I think if I just give them a check or, sign the order and get the contract today, we're okay, right, Bob? The reality is the IRS says it has to be available for use, which means it was unboxed and plugged in. It didn't have to actually be used. It had to be available for use. So if it didn't even arrive until January, it's probably not eligible, obviously not eligible for Section 179. And the difference between these two depreciation types are confusing. The biggest difference is that some states will recognize 179, but not bonus. And some will recognize bonus, but not 179. And so many times the decision about whether you took bonus depreciation or Section 179, or both, a combination of both, is based on your state income taxes as well, because obviously they're the same for federal. Here's a little, I'm going to show you the example here, though. What people don't realize is how powerful this really is in terms of cash flow. Let's say that you bought $150,000 worth of equipment coming up here on November the 1st. If you took out one of the loan programs where the 6 months of interest, no payments, just interest accruing, you haven't paid anything from by the time April 30th of 2025 rolls around, you haven't paid anything yet. And yet you got a $45,000 tax break for 2024. What most people always forget is that that means I could also lower my estimated tax payments by $10,000 because of that reduction. And that makes my initial cost negative $55,000. So I signed a promissory note in November. And if I go out to April 30th of 2025, I have $55,000 more in my pocket than I had before. And again, loan payments will start. But a lot of people talk about, the concern about the learning curve for new technology and things. Well, gosh, 55,000 should certainly help take away some of the angst for that learning curve period. Again, it's the fact that it changes not only the 2024 tax, but how fast you have to pay the 2025 tax. And it doesn't really lower the 2025 tax, it just cuts it back. But I would argue again, if someone said to you, hey, I'll tell you what, I'll give you a $40,000 loan, and you don't have to pay it back for a year interest-free, would you take that deal? Of course, most people would. The reason that it affects your tax payments is if for 2025, it's based on either 2024 at 110%, as long as your AGI, adjusted gross income, is more than $150,000. So the lower the tax for 24, the lower the amount that you're required to pay for 2025. That's the big difference. And so again, postponing the ability to pay $40,000 in taxes until April 15th of the following year is a pretty big deal. I would take that deal any day. This really does apply to all entities. I hear people say, oh, well, I'm an S-corp, or I'm a C-corp, or I'm just a sole proprietor. Doesn't that really apply? That's the thing I just showed you applies to everybody. Now, the only problem you have is with a C-corp. The C-corp does take a lot more planning in order to make that happen. And for the C-corp, you've got to actually make sure that you knew earlier in the year. You can't do it on December 15th. You have to have reduced your salary in the year knowing that you had this deduction coming. And by reducing your salary, you reduced the amount that goes on your tax return and basically took the tax deduction. So it just requires a little bit more planning. But, I'm honestly, I always advocate, a lot of people wait to the fourth quarter to try to buy equipment. Hey, if it was a good idea in the fourth quarter, it's a good idea in the third quarter too. You know what I mean? If you needed the equipment and the technology is something you're interested in, there's no time like the present to get that incorporated in your practice. Here's another example that I talked about earlier that I wanted to show you. And this is how the QBI and the 179 bonus depreciation kind of flow together. So I mentioned that dentists have an income limit to be eligible for the QBI. You can see at the top of the slide here that at joint, it starts at $383,900. So if I have exactly $383,900, I get the full 20% QBI. It phases out over the next 100,000. So by the time I get to 483,900 of AGI, I do not have the ability for any QBI. So I'm completely gone because they don't think you need it. You're obviously got enough income to not have to worry about it. So let's say you're sort of on that fence, you're in that between. Let's look at these two examples. I'm going to say one without 179. So the practice net income for 2024 is $490,000. I have some itemized deductions. My taxable income is $461,000, and the federal tax is $110,940. But now look at with Section 179. If I dropped my income by $150,000 for that piece of equipment that I just purchased, Look what happens. I not only get all my itemized deductions, I pick up an additional $68,000 QBI deduction. So you see the number in red over there. I actually got $218,000 more in tax deductions for only buying $150,000 worth of equipment. You can imagine what an incredible return on investment that becomes when IRS is helping to pay by lowering your income taxes on that extra 20%. So if you again, timing these, equipment purchases can have a big impact if you're right on that fence, if you're right within those, periods of eligibility. Make sure that you take advantage of that if the timing is right, because there is a really significant tax savings. Let's switch to the pass-through entity tax. I mentioned before that this is a way for the practice pay your taxes. Starting in 2017, Congress passed this SALT limitation, the state and local tax limitation of $10,000. Well, gosh, many of you who live in states that have high real estate taxes spend that alone just in real estate taxes, which means none of your income taxes become tax deductible. Part of the workaround that states came up with was an idea that said, hey, we get the same money, but why don't we let the individual entity itself pay the doctor's tax, send it in, that'll show up on a K-1 as withholding, but by having the practice pay it, there's a federal tax deduction for taxes paid. And because the state offered that as an option, now it becomes a tax deductible federal item. That can be a really big deal because, again, if you're already stuck with that limit of $10,000 and couldn't deduct any of your state income taxes, now you let the practice pay it, and it becomes tax deductible. There's 34 states that have some form of PTE. I have some of them listed here, but I'm sure that if you talk to your accountant and you're in a state that has a state income tax, you're probably going to be able to, for most of you, you're going to be able to take advantage of this. And I would highly recommend it. Just a really quick example here of this pass-through entity tax. Let's just say that the doctor had $266,000 of wages and K-1 income of $350,000. So it was a total of $616,000 for the doctor. Good practice. Here's the thing, if that doctor, however, because of the $350,000 in K-1, owed $17,500 in state tax, that state tax could be paid and would reduce the K-1 income by that $17,500, which saves that doctor $6,100. It's the same amount of tax, it's just who paid it. And by having the practice pay it, you got a $6,100 tax deduction. So again, pretty good deal. Take advantage of it, in fact, if you can. One of the other things I want to talk about is just, practice expansion. And we're going to talk about cost segregation studies in more detail, but cost segregation studies are where you can break the building components down into smaller pieces and depreciate them more rapidly. But one of the other big things about that is, I don't know if any of you have moved into a space and you had to pay for the build out. You did the leasehold improvements. Sometimes if you have to leave that space before you're done depreciating them, people forget about what a really big deduction that becomes. Here's an example I want to use. So when you abandon these leasehold improvements and by walking away from them, you get a deduction. Here's an example. If you made $300,000 of leasehold improvements in 2014, and you picked 39 years, which was what you were required without a cost seg study to depreciate it. Now you come along in 2024 and you've outgrown that office and you say, well, listen, I want to move on. I want to go up. I want to expand my number of operatories and, be able to grow. That's fine. But when you leave that, there'd be $215,000 of leasehold improvements that had not yet been deducted that are all immediately deductible the year you abandon that leasehold property and walk away. And, again, when you're going through a big building project like that or a relocation, when do you need the tax deduction the most? It's right then. So don't forget that can be a huge benefit if you're thinking about moving out of a leased space. And regardless whether it's into another leased space or into your own new building, it can be a huge write-off. I want to talk about cost segregation. I'm not sure how people have ever heard of that. I call it turning studs and drywall into Section 179 because it basically turns part of the building into equipment rather than a building. The IRS says that a commercial building has to be depreciated for 39 years. 39. The problem is not all the components of the building are going to be alive and still be there in 39 years. What happened was the Hospital Corporation of America over 20 years ago fought the IRS and won. They said, well, listen, if we build a hospital, the carpeting or the flooring or the ceiling tiles, I mean, they're not going to be there 39 years from now. So it's stupid for us to depreciate it over 39 years. We're going to pick the useful life. And they all went through tax court and won. So now the IRS has all of these, procedures set in place of how you would actually, do the model and actually get the tax deductions by breaking it down. Let me show you just a quick example. Let's say you had $1 million in building costs. Eventually, you're going to get $400,000 in tax savings. But with straight line depreciation, it's actually, I said 39 years, it's because you have to take a half the first year and a half the last. It takes 40 years to get the entire deduction. That's only $10,000 in savings, over 40 years per year. With a cost segregation study, a minimum of 20% of that will turn into a 5-year immediate tax deduction as if it was equipment. It could be that 200,000 in this example could be elected to be immediately deducted, as could the 7-year and maybe the 15-year as well. But again, that creates $80,000 in tax savings in the first 5 years. And again, when did you need that money the most? When you just took on a big mortgage and you've got a big lump in your throat because you built a new building or did whatever. So regardless of whether you did leasehold improvements or built a building, these things apply. You can get a study done. There's a lot of numbers on the page here, but let me just tell you that if we send in, the cost of your building and some estimates from the builders, you can get a breakdown like this that'll estimate the actual benefit that you probably will get by doing these studies. Many times these studies can cost $6,000, $7,000, $8,000. So you want to make sure that you've got the benefit back. But it's rare for anybody with a decent sized building project not to have a super benefit from doing one of these. This is also $500,000 in tenant improvements. So again, you don't have to build a building. You have to just incur the cost to try to improve the practice and expand. And by moving that out of the green box at the top there is talking about all the categories that this was broken down into. In this particular case, 45% went into 5-year property because it was tenant improvements. The landlord already put up the outside walls and the roof and the windows and the things that have to be taken a long time. The non-load bearing walls are the ones that create those 5-year property. And so many times a build out can create an even bigger tax deduction than a brand new building as compared to the total investment. Again, if you don't forget anything else we talked about tonight, just remember these 2 boxes. One is that I broke the building down into pieces and got to take some immediate tax deductions. And the yellow is, oh, nope, I'm stuck with the whole thing spread out over 39 years, really 40 when you count the other halves. So many of you will build a building and not intend to even stay in it 39 years. You want to sell the practice and move on. So speeding up that depreciation can be absolutely critical when you're talking about, the tax benefits that go along with a new building. Let me give you just a really quick example. Everyone knows that's an outlet. But if it's plugged into a fax machine or a computer, now it becomes a computer. But it's not just the actual outlet itself, it's all the wiring that went back to the breaker, part of the breaker box, part of the permit, part of all of the costs associated with that building that went into that. And it turns into like a $350 tax deduction for one outlet just because it's plugged into some equipment. Another quick example, there's just a sconce, a decorative sconce. Would that be something you'd have to take over 39 years, or could it be equipment? Well, the answer is equipment. Because it's not structural, it's not necessary, it was decorative in nature. Those things can be split out and take an immediate tax deduction for, or again, spread it out over 5 years, not 39, big difference. And when you think about all the infrastructure in a building, dental practice, all the plumbing, all the electrical, everything that services, that's under the floor, everything that services that dental equipment is all dental equipment. The only thing that does not qualify are the load-bearing walls and roof, windows, exterior doors, that sort of thing. And land never qualifies, so you can't depreciate land. But everything else, you can see in a typical dental office how you can wind up with a lot of the cost of a building broken back down into things that look like dental equipment, if you know what I mean. Here's the really big thing. If you remember nothing else tonight too about this, if you did have a building project or something recently, I mentioned the taxes are on sale at 12%. And I put over the 2024 federal tax brackets out there. You can imagine that if I used, if I used all of my income or all my deductions to get my income down to zero, you can see in the married joint filers, I wasted $23,000 that I could have only paid 10% tax on. I argue the taxes are still on sale when they go to 12%. Though I really don't mind for a married couple to have, even in the middle of a year like this, if you have 94,000 of taxable income, that means you've saved some of those depreciation deductions for some other time down the road when you're going to be in a 35, or 32% bracket. So a much bigger bang for the buck if you're taking a deduction down the road. And what typically happens, this is pretty typical, by timing the study, by not doing it the very first year that you built the building. Because most people that build a new building have a lot of new equipment purchases and things that are immediately deductible anyway. They didn't really need the write-off. So that you could have lowered your tax bracket just with the equipment. But if you wait to the next year or even the third year and then do the cost segregation study, you're allowed to take all the depreciation that you could have taken in that first 1, 2, 3 years, all in that year. And now again, in year 3, your income's up, the practice is really, hitting on all 8 cylinders. And when did you need the deduction? Well, you needed it then. So just wait, pause, and do that cost segregation study later on. It might be of a significant tax benefit to wait. Switch over to the HSAs, Roth IRAs, and some of the 529 topics I wanted to cover here tonight. The HSA limits for 2024 are up. They've been indexed up a little bit, but it's $8,300 for families, as you can see, $4,150 for individuals. And if you're older than 55, you can throw an extra $1,000 in there on top of that. The IRA limits this year are $7,000. Again, $8,000 if you're over 50, or up to the amount of your taxable income. So let's say we're talking about paying one of your children for working in the practice or the use of their image or something like that. The goal will be to say, listen, can I get something so I can justify paying them at least $7,000? That would enable them to have a $7,000 Roth IRA. And the actual income tax federal income tax on $7,000 for a child is 0. So that part's a pretty sweet deal. Keep that in mind. That's kind of a target goal if you can put your kids to work. Contributions to the 529 college savings plans are considered completed gifts. So if you have a grandparent who say, I'd like to pay $200,000, put it all in a big college fund for kids. The problem is now you have to file a gift tax return. To avoid filing a gift tax return, as long as you're under the annual exclusion, each parent could put $18,000 up, so $36,000 in 1 year in a child's 529 plan and not have to file a gift tax return. So it just makes it a lot simpler. And again, $18,000 may be higher than you absolutely need to fund it, especially but for those older kids, if you're getting started saving later and you're trying to push it up, just realize that when it goes beyond that, you may have to file those gift tax returns. Also talk about other contribution limits. The Roth IRA, you're not eligible to do a Roth IRA if you're single and your income was over $161,000, or if you're married and it's over $240,000. In the single bracket, if you're under $146,000, you can do a Roth IRA, even if you have a pension plan at work. If you're, a member of your office plan, you could do a Roth IRA on the side. Same thing with married. In between those two income limits, it gets phased out. You can't do the whole $7,000. You can only do part of it. But there's another provision that people, many times they say, well, I've heard about that. It's called the backdoor Roth. Here's the thing. There's no limitation whatsoever on putting away money into a non-tax deductible IRA. Just a traditional IRA, and you elect not to tax deduct it. That's just an election on the form you sent in. Now the money goes into that non-deductible IRA, but you immediately the next day convert it to a Roth IRA, which is completely legal. Why they make you jump through these hoops, I have no idea. But if you the point is, if you have a high income, if you're over those Roth limits and can't put money directly into a Roth, do not despair. Just go around the back door and do it the way it's still legal. Congress has talked about fixing this, and we'll see what happens with the new elections. We'll see if this really does come to play. But this is a good way for high earners to have access to a Roth IRA, because it's really nice for you to have money in two different bowls in retirement. Obviously pulling money out of your Roth IRA in retirement is not taxable. And so if you go to buy a car, you go to buy something like that, it'd be nice to have that extra little drawer you can pull out and say, ooh, I'm going to take some money out this year for that, but I'm not going to have to pay any tax on it. So again, keep that in mind. Let's switch to the pension plans. A lot of people don't realize that if you start with the basic IRAs that we talked about, but then they have a simple IRA plan, and that's where the practice itself is sponsoring the plan. The maximum voluntary contribution is $16,000, $19,500 if you're age 50 or older. The practice then matches that with 3% of your income. Let's say you've got $300,000 of income, you voluntarily put away $16,000. The practice could put away another $9,000, you'd be up to $25,000. So if $25,000 per year fits your spending intent, that's perfect, because they're the cheapest plans. They don't require any other, tax returns with the Department of Labor. They're very easy to manage, simple. You do have to do the same thing. You've got to match up to 3% any contributions that your employees made who are eligible. When you go and say, listen, that's not enough, I really want to put away more money, you can always jump up to the 401k plan. Those right now have a maximum voluntary contribution of $23,000, $30,500 for age 50 or older. But then the practice can also match and put money in and beyond that up to $69,000. So that's a much higher limit if that's where you need it to be. If you really want to take, to the next level, there's defined benefit plans. They're called the category of defined benefit. There's cash balance, there's all kinds of things, but in that category of defined benefit, not defined contribution, the maximum by the time you're age 66 is $376,000. So if you have a banner year and you want to really knock it out of the park, you do have the ability to change to a plan that has that. And the other thing, the next one is the combo plan. What if I have a 401k, keep that, and also put a cash balance or a defined benefit plan combo on top of that? Now we're up to $452,000 you could tax deduct by age 66. Those increase, but all of the defined benefit plans have much higher contribution limits than any of the other first two on the screen there. So realize that there are other options for you to consider if the plan that you have isn't really hitting the goal that you were hoping for. We talk about this as just a little thing. I don't know if we have any younger graduates on here tonight, but if you went to dental school, you had to buy books, loupes, articulator, maybe hand instruments. Some people have said, well, they were included in my tuition. Well, they were all in the soup. So the actual market value, the used market value of those things, when you graduate and go to work as an independent contractor with your own LLC, those things are now converted from educational use to business use. And that makes a big, that could certainly be a big tax deduction. It also means if you previously purchased a laptop, printer, modems, whatever you have, desk, bookcase, anything at all that you had originally, but that you've now converted to business use, can become an immediate tax deduction when you start your LLC and have those things available for use. They don't have to actually be used. They have to be available for use. So they can be on the shelf, but it's part of the deal. So again, that's just one of those things that if you're a young doctor and you've done that, you started your own LLC, make sure you pick up that deduction in the first year. One of the other things that I see overlooked quite often is, especially for wealthy families, is family limited partnerships. Family limited partnership is a special type of partnership where because it's all one family unit, with the rules of attribution, they're all considered one taxpayer. So even though the parents may own, or the dentist may own the building, if the children are part of this family limited partnership, they may only be 1% and the doctor 99. But the children could now get 50%, let's say, of the income. You're allowed to do what's called anoint these other partners with a larger income beyond their percentage of ownership because it's a family limited partnership. And I tell you, that can be a really big deal. Remember, if you're trying to give your 20-year-old some extra cash, and kids never need my extra money, right? If they were part of the FLP and you had rental income profits, you could give it to them. And then that K1, they would pay in their income tax bracket. If they're out and independent, you might have the ability to be able to, put that in a much lower bracket. And I said, we've had a couple clients. I have a client with a sister with special needs, and he made her part of this family limited partnership. And it's a way for him to spin off money and give it to his sister, but let her pay for all that tax in her bracket. I want to throw in one more topic before we go to questions here tonight, and that's this whole thing about the beneficial ownership reporting. This Corporate Transparency Act that was enacted in 21, it became effective 1/1 of 24. I would tell you, I have talked to so many people that have never heard of this and have no idea that they have any requirement to do this. But this is really going to come back to bite some people. And FinCEN, the Financial Crimes Unit, basically got the right to force every business owner to have to log in and put in a copy of their driver's license, passport, something like that, along with all of their basic information, so that they can prove who really owns this company. There's way too many shell companies out there that are owned by entities that no one recognizes and no one can find. They want to stop that. They don't want the bad actors to be able to set up these shell corporations and then do that. Otherwise, there are going to be significant fines. Now, again, the actual process is pretty easy. If you Google BOI or FinCEN or any of the Financial Crimes Enforcement Network, you get to the website and you can go do it. It's pretty simple, just to scan a copy of your driver's license and fill in the address and that sort of thing. It took me 10 minutes to do it. But it's just that you have to do it. And I bring this up because the failure to do that is $500 a day, up to $100 or $10,000, which is again 20 days. You only have to be 20 days late to pay a $10,000 fine, and up to 2 years in jail if they can show that it was intentional. If you created a new LLC or a new entity, these are all businesses that had to file with the Secretary of State. So not a sole proprietor, but any corporations, LLCs, partnerships, that sort of thing. If the company was created after 1/1/24, you had 90 days to do this and get it filed. Anybody that was already in existence as of 1/1/24 has until the end of this year to do it. And the owners who have to do this, and again, if there's 3 or 4 owners of the practice, they may all have to go and do this. Because if you own more than 24% of the practice that you are in, any business entity, whether it's the building partnership, whether it's the practice entity, I mean, every corporation that you're a member that you own more than 24% of, you have to log in and tell them that you're part of that corporation. And like I said, the failure for this is pretty steep. So I just want to make sure that we're out there spreading the word so that no one gets sucker punched and says, oh my gosh, I paid a $10,000 fine because I was late. I don't want to see anybody on this webinar get stuck in that particular position. Let me wrap up quickly so I can leave some time for questions here. Again, I always say tax planning is really complicated. You do not want to wait till April to start this. If you treat your accountant as an archaeologist who just blew the dust off what already happened and it's too late to make any changes or make any recommendations, then that's not really that helpful. I think you can see that how the new equipment purchases or even used equipment can have a really big impact on your taxes. So don't discount the benefit of doing that before the end of the year here. Make sure if you're in a state, one of the 34, that you're paying the pass-through entity tax. And again, choose wisely before you automatically take accelerated depreciation. If you're one of those doctors who has $200,000 of income but bought $200,000 of equipment, don't take all of it in the first year. Taxes are on sale and they're 10 or 12%. I'm begging you to hold off and save that for a higher tax bracket down the road. And remember the little box breakdowns on the cost segregation studies that you can break a building into certain components. Just keep that in mind. And that's all you have to remember, because you can talk to your tax professional when you've done one of these things. And again, for up to several years after, if you forgot to do it, you can go back and do it now. And last, of course, was the FinCEN deal. We don't want anybody wind up with $10,000 penalty. So log in and Google BOI, beneficial owner information, and FinCEN, and you'll find that pretty quickly. For anybody that's interested, I'm going to leave this up on the screen for a minute. If you scan that QR code, you actually get a copy of the book shown on the right-hand side there that talks about a lot of the things we talked about today in greater length. I put that together in conjunction with some other authors and Henry Schein, and they wanted to have a written copy that you could take with you and refer to later. So if you want, just scan that to a QR code, and all you have to do is enter in your name and email address, and you'll get an ebook copy of what we've talked about here today. I wanted to make sure I saved time at the end here for the Q&A, because I think when you've got a free accountant for the night, it's always a great time to be able to bring some questions. So do we have some questions here tonight?
Yes, we do. Thank you so much, Bob. That was wonderful, replete with information. And we do have some questions that have come in, so I'll go ahead and read those.
Okay.
This one comes from Emily Chang. If a purchase is made for the office, for example, a table or sofa for the team, not for the patients, is that eligible for tax deduction, similar to Section 179 equipment deduction?
Yeah, absolutely, yes. It doesn't make any difference whether it's patient-facing or strictly part of the office, that you just for the operation. It could be anything within the walls of that office for furniture is tax deductible, as if it was, in the operatory as well.
Great. And this next one from Tu Doan. Any LLC company has to file with FINCEN, FinCEN?
Correct. Any LLC, because in order to create an LLC, you had to actually go to the Secretary of State and create an entity. They got what I call the birth certificate back, which is a certificate that's saying, okay, as of this particular date and time, now this entity named blah, blah, blah LLC is an official entity in the state of wherever you are. Once that happened, that clicked the switch and requires you now to file with FinCEN. And as I mentioned, if you went into this with a partner, make sure that both of you do it. It can't just be one of you. 50-50 ownership, you're both over 24%. You both have to go in, log in and do that. And don't forget the other entities. I have a lot of clients who have a building in one LLC, and maybe the practice in another LLC, maybe even some other investments in LLCs. If you have 2, 3, 4, 5, however many you have the obligation to go in and log in and report it on every one of those. You just need the federal ID number for the entity that you're trying to report, and then you put your name in and that sort of thing. And again, it links you to that entity, so that if they're looking for bad actors, they want to be able to find someone pretty easily.
Thank you. This one is from Ludmila Tesoro. Please, can you share your contact info, number one? And I know you put that up there. And second question from Ludmila, the first year EBITDA is negative, generating a loss. Is it an issue to start with accumulated losses and no tax to pay?
Sometimes that's unavoidable. I would say that if you start a practice and you do have a negative number on a K1, again, especially you started more later in the year, it's pretty unlikely you're going to have a profit in a dental practice. It just takes too long to get credentialed. It takes too long to get that stuff done. So the answer to the question is no. It's just that if you're in an S corporation and you've got a big negative number like that, it might not be tax deductible. It might be something you have to carry over into a future year. But it's from a tax perspective and from an IRS perspective, it's not questioned or it's not unusual. So don't feel like it's a red flag. It's not a red flag if that was part of the concern.
Wonderful. This one is from Shannon Spalding. This is the first time I've heard about the BOI filing. I am in an S-corp LLC. Do we need to do it? Does it apply to all states?
Yeah, it applies to all states because it's a federal program. And I tell you, this is I started when I talked about BOI. When you talk about this to your friends who also own dental practices or any other business owner, I mean, it's not obviously just dental practices. I have seen so many people just shake their head and go, "What are you talking about, Bob? I have no idea." FinCEN has been horrible about advertising the need to do this. And you've never gotten any letter in the mail. You've never heard anything. They put this out on a website. You don't see any commercials on the TV saying, "Hey, by the way, go to FinCEN," and it's the best kept secret in the planet. But boy, they sure have the penalties built in there. $10,000 for not doing it and missing it by 20 days is pretty darn steep. That's why I wanted to bring it up, because I think there's just a lot of people that are going to wake up and go, "Oh, I got a letter from FinCEN that said I have an LLC, S-corp, whatever, and I didn't file, and here's my bill for 10,000, and I better do it now or I'm going to jail." It's horrible that the government has done it this way. There's been a lot of talk. If you actually Google it now and read about it, some people saying, "Well, it's a violation of my rights. I shouldn't have to tell you all this information, government, blah, blah, blah." But hey, Congress passed it. FinCEN's going to enforce it, and don't pay a $10,000 penalty. Just log in and get it done. But yes, it does apply to your S-corp partnerships and C-corps.
This next question, what is the benefit of going from an LLC versus switching to the S-corp?
So remember that an LLC is basically just a type of corporation. An LLC can start as what's called a disregarded entity, which just means that even though you're protected by all the things of an LLC, you can basically just put it on your own personal tax return on Schedule C. It's as if the LLC did not exist. Or you can be a partnership with other partners. The benefit of going up to the S-corp is it's the same LLC. It's just a one-page form that you send in that says, "Hey, effective this year, now I want to be taxed as an S corporation." The benefit of that S corporation is that if your income is above those QBI limits, remember I had the slide up with the QBI, if your income is over $400,000 and you're saying, "Well, gosh, my QBI now is really, really limited," or "I'm at $500,000 of income. So Bob, the QBI doesn't mean anything to me." Well, now I'm not worried that I have to take a W-2, but you have to take a W-2 from an S corporation. You have to take what's called a reasonable salary. So if your income was below that, you wouldn't want to take a salary, right? Because that's the part that is not eligible for the QBI. That's why a regular disregarded entity LLC would be better until your income gets that high. Once it is that high, though, now you can say, "Well, listen, if of my $600,000 in profit this year, I'm only going to take $250,000 of it in the form of a W-2. And I'm going to take the other $350,000 on my K-1 as dividends. Still get $600,000 of taxable income on my 1040 that year. The difference is that other $350,000 is not subject to Medicare tax. So you're basically saving about 3% on all the money that came to you from that S-corp as compared to the W-2 wages that you would have had. And again, as a sole proprietor, disregarded entity LLC, or a partnership in an LLC, all of your income is subject to Medicare tax. So that's the benefit of being an S-corp.
Thank you, Bob. This next one is, first year EBITDA is negative, generating a loss. Is it an issue to start with accumulated losses and no tax to pay? Oh, this one we did already.
Yeah, that was the question. The answer was no, not
that was the question before.
Yeah.
Not a problem. From Emily Chang, when does the mileage rate apply as a deduction? Is that only for those with more than one office? For example, driving between offices?
So clearly driving between offices is definitely business, but I'm a huge advocate of saying, several years ago, the IRS basically eased up on the home office rules. The home office rules used to be that you had to have a separate structure. I mean, think of a shed out in the yard somewhere in order to have a home office. They lost so many court cases that they finally gave up and said, "Okay, we're going to come up with the EZ method." And the EZ method is if you use regularly 300, a square foot of your house for business, then we're going to let you get a $5 deduction up to 300 square feet, $1,500. And most people go, "Well, Bob, okay, wow, $1,500 tax deduction, that's great." But now remember, If the practice reimburses you for that $1,500, saying that you did need that confidential space, you needed the extra room in the garage, whatever it would be, they've now admitted that you're going from your home office to your clinical office every time you put the key in the car. So that makes a substantial difference in what is considered business mileage. I think you can pick up all of what otherwise would have been commuting as a business tax deduction.
Okay, great. Thank you. How about an S corporation? Also need file financial crimes enforcement?
Yep. All S-corps, all LLCs, all C-corps must file with FinCEN.
Great, thank you. This from Ken Gerson. I didn't have a link at the destined designated time, even though I was registered, and the registration said this webinar starts in 24 hours Thursday. How can I view the whole webinar later? Because I missed a lot of it. Thanks. No problem. We are going to be sending a link out to tonight's webinar with Bob Gray. This has been recorded, so we're going to be sending out a link sometime in the next week to everyone who registered. So not to worry, you should be receiving it, Ken. This next one is, and then just these are the last two. I have a W-2 spending most of my income in the new practice, set as an S-corp, 2024 in construction, maybe start on December. Can I net income and get a tax credit if negative? I don't know.
Yeah. So first of all, you never want to create a negative in an S corporation. You should discontinue your salary until you get to the point, because it does you no good to put money in on your W-2, pay Medicare and Social Security tax and all that income on it, only to have that reversed at the end of the year by trying to take a loss. And many times, if you borrowed all the money it took to create your new practice, you might not even get to take that loss at all. So make certain that you do not have an S corporation with a loss when it's possible. Now, if you just started a practice, it was only a few months ago and before the end of the year, yeah, but stop taking salary from an S corporation that is going to be showing a loss if you continue to do that. You could borrow money from the company. You can do it if you have cash available. You can again take a shareholder loan, but stop taking salary. You do not want that loss.
Thank you. And she's just clarifying that she works in a dental office with a W-2.
Oh, if you're only a W-2 employee, unfortunately, you're not eligible for the QBI at all, right? Because it had to be business income. It had to come from an S corporation. It had to come from a partnership or something. If you're basically just a W-2 employee, unfortunately, the QBI does not apply to you at all.
And this last question, Bob, sounds a little specific and maybe needs a one-on-one consultation, but I'll read it here. As you said before, FinCEN is not marketed well. This is my first time knowing. What if a non-dental LLC was created this year and you passed the time frame, planning to file it, but will I still be fined?
Well, the answer is, will you be? You have to believe there's going to be a lot of leniency in here. And the other thing is, they do ask you, when did you actually start using this company? I mean, could you take the position that, yeah, I did it in, June, but I didn't really start to utilize the company yet. Maybe it wasn't properly funded until now, so I'm still within that 90-day period. So whatever date you put down, if there's a way for you to legally put, something that was less than 90 days, you're not going to get fined anyway. But I would certainly point out, if you do the filing, there's a place for a comments section where you could say, completely unaware of the filing requirements until there was no attempt to, voluntarily ignore the rule. So.
That's very helpful. Thank you so much, Bob. And thank you so much for tonight's presentation again. That was really wonderful, so full of info, of important information. And I want to thank everyone who joined us tonight. Please join me in thanking Bob. And again, we did record tonight's webinar, and we're going to be sending the email out with the recording sometime in the next week. And we would appreciate your feedback. That's going to pop up as a survey on your screens shortly. Again, thank you guys for joining us, and we look forward to seeing you on future webinars. Have a great night, Bob.
Yep, thanks to all. I hope you found the time worthwhile.